So IFRS 2 relates to share-based payments, and that's now a fairly common way of rewarding employees for the overall performance of the entity, as well as their own performance, by means of offering shares instead of monetary compensation in return for meeting certain performance targets. As I say, they might be both personal and organizational targets. And essentially what we have here is a way of incentivizing employees to perform well individually, and also indirectly to recognize that the entity as a whole also needs to perform well. It's important that the entity as a whole is successful, and this gives people a degree of buy-in into the organizational performance. There often be some criteria, of course, in place for this, against which they'll be measured before share-based payments are made. So that's a very common thing these days, to have these employee share schemes in place. And there might also be other circumstances where shares are paid out by the entity in return for the delivery of other goods or services for another entity. So in terms of the accounting implications here, the normal approach where goods or services are provided to us is to ideally ascertain the fair value of the goods and services which have been provided to us, and that would basically, from that we would derive the valuation of the share-based payment which we would include in our financial statements. If, however, for whatever reason, we don't have such a fair value for those goods or services, or is not easily accessible, then the alternative approach, which is allowed by IFRS 2, is to use the fair value of the equity instruments which are given in exchange. And there's one other key accounting issue to consider here, and that's the timing of recognition. Normally with goods, this is not too much of an issue. So when goods are delivered to us, or when we take control of goods, the date on which we do that is the date at which the transaction is deemed to take place, and the equity-based payment would be recognised as at the same date. And that's the date which would drive when it's included in what period in the financial statements. Things are a bit more complicated with regard to the delivery of services, where the default situation is that when the equity instruments are paid over, that the services have already been delivered. So in summary, the main accounting issues to consider with IFRS 2 are both the valuation, revolving ideally around fair value in one form or another, and also the timing. And it's on these two key accounting points that we should focus our attention if we're dealing with IFRS 2.